So many traders lose lots of money and give up trading simply because they don't understand market structure. So if you want to stop screwing up your account, make sure you watch this video to the end. In today's video, I'll be teaching you how to become profitable simply by using the concept of market structure. So when you open up a chart, what is the first thing you look out for? First thing every trader looks out for when they open a chart is to know whether the market is going up so that they can buy and make some money, or to know whether the market is going down so that they can sell and make some money. When the market is moving up, it is called an upward trend, and when the market is moving down, it's called a downward trend. And the trend is simply built on market structure. So you must understand the concept of market structure for you to properly capitalize on the trend and make money with the trend. And that is what this video is all about. So there are 4 things that make up market structure: higher highs, higher lows, lower highs, and lower lows. So in an upward trend, the trend is characterized by higher highs and higher lows. And those higher highs and higher lows are the structure in an upward trend. That is what makes the upward trend a trend. If a new high does not take off the previous high, then it's a signal that the structure is failing and that the upward trend may not continue. And if a new low takes off the previous low, then the structure is broken and a reversal is imminent. Now, for a downward trend, the price drops and forms a low, then moves up to form a new high, and then drops again, taking off the previous low to form a lower low. There is a low lower than the previous low. Then it rallies again to form a lower high. And after the lower high, it continues in the downward movement and takes off the previous lower low and forms a new lower low, then rallies again and forms a lower high. And in that manner, it continues. So in this downward trend, our attention is at the lower highs. If the price, for any reason, takes off the most recent lower high, then the structure has failed, and we'll change our direction and start looking for opportunities to buy instead of selling. So it is the structure that helps us identify the trend and also know where the price is going to face some reactions from the market. You can pause the video and go to your charts, pick up a rectangle or text, and begin to mark the higher lows and higher highs and the lower lows and the lower highs in your chart. So now that you understand what the market structure is and how to identify them, the next question would be, how do you trade market structure? To trade market structure, you need to pay attention to the most recent highs and lows that you're seeing in your chart. That is what you're going to mark out and trade off the structure, the most recent highs or lows, because that is where the market is going to react to the price. So you open a 4-hour time frame chart, spot out the significant highs and significant lows. When you've identified your major structure in the 4 hours time frame, then you need to go to a lower time frame to make your trading plan. The trading plan consists of where to enter the market and where to exit the market. So that is what you're going to do with this structure. You're going to think of, where am I going to enter the market? Where am I going to exit the market? So to find a trade, you need to find out where you are right now. So what will be your entry strategy? If in an upward trend, you don't jump in when the price is creating a higher high. You wait for the price to pull back and create a new low higher than the previous low. Then look for candlestick confirmation patterns and enter a buy. Then place your stop loss below the recent low and then target a new high higher than the previous high. This is where most Forex traders get it wrong and fail, because many a times they just want to jump in when they see price creating a new high. You don't jump in that way. When you do, you lose money. So the best option is, when the price is creating a new high, be patient. Patience is key. Be patient and wait for the price to pull back. And when it pulls back to one of the minor structures that you've drawn, then you can look out for a confirmation signal in form of a candlestick pattern like a doji or a bullish engulfing candle. Then you join. Once you observe that confirmation, you can buy and put your stop loss below the recent low, and then your target should be above the most recent high, because in an upward trend there should be a new high created. So that will be your target, and your risk reward ratio should not be anything less than 1:2. Should be 1:2 and above. In a downward trend, once the price breaks a lower low and starts moving down, creating new lows, don't jump in immediately. Allow the price to rally back into one of the structures that you've drawn. Then you can join the bears and put your stop loss above the most recent high, and your take profit should be below the most recent lower low. So let's go to our chart and see some examples. So this is a 4 hours time frame chart. So let's mark our significant levels. You can always note some of these levels by the change in direction experienced in those places, and also by the wicks, presence of wicks in the candlesticks. This is the low. With this Euro JPY 4 hours time frame, we found out that the most significant high was at this point, and then it broke this low with up to 4 weeks. And then as it broke with this candlestick, the option was not to jump in and start selling immediately. Rather, it was to wait for a pullback. And the next candlestick did that very clearly and rallied back into that zone. Now, when it rallied back, the trader is supposed to move to your lower time frame to look for opportunities to sell to a new level. Going to 1 hour time frame or 15 minutes time frame. So this was what happened there. As the price rallied back and it was rejected at this point, it was rejected here. So in the 15 minutes time frame, after the break, it got to this point, but price was rejected with this bearish engulfing candle, and then this should be your entry point. Then we entered at this point, and when you enter at this point, at this 15 minutes time frame, the price drops and you're expecting to join it to a new low, and the price continued to this new low. In the 4 hour time frame, when we got to this new low, price broke. We did not jump in immediately, waited for price to retrace a little. So the secret is that after every break in the 4 hours time frame, wait for 1 or 2 candles to pull back or to retrace to the point of that break or near the point of that break. Then go to the lower time frame and start looking for opportunities to short or to long the trade. So in this case, there was a break at this point, and there was a pullback with this one candlestick. If you go to the 1 hour time frame, you will see here was it at the 1 hour time frame. After the break, there was a pullback here, followed by this strong rejection, and the price continued. And after that, getting to this point, it was stalled again, and the price moved up. In the 4-hour time frame, we saw about 2 candles. Here is about 3 candlesticks backwards, and the price was rejected again. So looking at this, you find out that the previous high is always higher than the most recent high. And now that this price is at this point, we're not going to jump in and start selling. We will wait for 4-hour candlestick to come back towards this point where it has broken, and that will be the point we'll be looking for sell opportunities. And our stop, in any case, wherever we enter each of those trades, our stop will always be above the previous high when we are selling. We are not concerned with the lows because we all know that the price is going to be falling. So our concern is with the high. So we'll always be hiding our stop loss just above the previous high. I hope this is not too ambiguous, but let's look for another chart to illustrate. So this is AUD USD 4 hours time frame chart. We've identified our significant levels, higher highs and higher lows. From this lowest low, price moved to this new high, and after this high, the price retraced a little to this point. We look for a confirmation in the lower time frame and join the buy here, and moves up to take off this previous high up to this point. Now when we are here, we wait for the price to drop again to pull back, and as the price pulls back, we'll be watching in the lower time frame 1 hour or 15 minutes for a confirmation candle to join the bulls and move up above the previous high. And after that, we wait for a pullback. Then with this doji that formed there, we're able to join the price up here again. That is how we continue moving, just trading between those higher highs and higher lows. After every break, we wait for a pullback, 1 or 2 candles on the 4-hour time frame, then we move to a new high. However, the most recent low, this low was broken at this point. At this point, this low that was created was violated at this point. Then our sentiment changed from being bullish to becoming bearish. So now that this place has been this most recent low has been violated, then we start selling, hiding our stop just be above the most recent high. That is how you identify your market structure and you trade them. I hope this video has helped you. Please, if you have any questions, kindly drop them at the comment box. Thank you for watching.